McHenry, the chair of our Oversight and Investigations Subcommittee.
Chair Yellen, congratulations on your appointment and being an important mark in the history books as well.
Thank you.
I have a question. In 2010, you spoke that banks may be required in their debt stack, in their capital, to use a convertible instrument that in good times has a debt nature and in bad times converts to equity. You said that they may be required to do this. Is this your intention to use this instrument?
So I think when I gave the speech at that time, I was broadly considering possible regulations or shifts in the focus of supervision that might be helpful. I think there still is focus on something like that. I think to improve the resolvability of a large banking organization, something that the Federal Reserve and other regulators are contemplating is a requirement that bank holding companies hold a sufficient amount of long-term debt. It would play a role similar to the contingent capital instruments you've described.
So you mentioned that in your opening statement about this requirement on long-term debt. Would it be your intention to have this contingent convertible capital as a part of that long-term debt requirement?
Well, I think it bears, this type of debt would bear some similarities. It's not exactly the same, but it bears some similarities to contingent debt in that it is a source of gone concern value that would be there if an organization got in trouble that would serve to recapitalize it. And so the existence of such a class of debt, I think, would give proper incentives to monitor risk-taking in these organizations.
So are you still broadly favorable towards these contingent convertible?
I mean, there are a number of issues associated with that kind of debt, what would trigger that and so forth, but I think it remains an interesting possibility in this proposal.
An interesting possibility. Well, that's a fair admission from a chair of the Federal Reserve. So I'll take that as somewhat favorable, if I may. And I was reading yesterday in the Financial Times. We have this discussion about the Volcker Rule and the exemption that the Volcker Rule provides for sovereign debt vis-a-vis corporate debt in the United States. And I read in the Financial Times yesterday that Danielle Nui, who's the head of the Bank Supervisory Agency in the European Union, she said that they're really going in a different direction in the EU. And in light of their recent crises with sovereign debt, she said one of the biggest lessons of the current crisis is that there is no risk-free asset. So sovereigns are not risk-free assets. That has been demonstrated, so we now have to react. In essence, the EU is going a different direction when it comes to sovereign debt than we are in the United States. How would you react to that?
I believe the exemption for U.S. debt markets was built into Dodd-Frank. That was explicit in Dodd-Frank.
Okay, but what is your reaction to that? We're policymakers. We could remedy that if you think that that is a flaw.
We've tried to write a rule that that is consistent with Dodd-Frank as it was legislated.
So would you look favorably upon us saying that sovereign debt should not be exempt or should be comparable to corporate debt?
It's something that I would have to look at more carefully.
But did you not look more carefully at this subject matter when you wrote the Volcker Rule?
Well, we put into effect the allowance that Congress included in Dodd-Frank to exempt Treasury securities.
Yeah, well, no, that's Treasury securities. I'm asking about sovereign debt, which was excluded from the Volcker Rule. Written into the language of Dodd-Frank is exclusion of U.S. sovereign debt, not the exclusion of other sovereign debt. I would call this a lack of enthusiasm from you, I would surmise.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts.